Let's get back to markets here and talk about emerging markets in particular because they're catching the eye of investors. Global X, for one, noting a significant pickup in interest in emerging markets as it steps out from the shadow of developed markets. Malcolm Dorson, Global X Senior Portfolio Manager, joining us now to discuss. So, Malcolm, start with what you're hearing from clients on emerging markets here and why you think there's been a pickup in interest.
Sure, Julie. Thanks for having me. Well, I think a few reasons. First of all, investors have been dramatically underweight emerging markets for the past decade, and it's really worked. We've seen a lot of success based off of U.S. exceptionalism. But now emerging markets are getting to the point where valuations are just too compelling to ignore. We're now also seeing a little bit of momentum, being the second or third best performing asset class in the world year to date. And in addition to that, people are looking for different opportunities, whether it be alpha generation, portfolio diversification, or just plain old U.S. dollar hedge, given the concentration of performance that we've seen in the U.S. thus far this year.
So Malcolm, let's dig into some of these opportunities. You kind of divide them, Malcolm, into different buckets here. So in your structural opportunity bucket, for example, you like India. Make the case there, Malcolm. Why India? And also, by the way, do you think it's sort of fair the way that people compare India to China, or no, do you think they're just too different economically and demographically?
Yeah, no problem. Thanks, Josh. You can compare it, but end of the day, it's an easy comparison because I think it's a better opportunity. Unlike most opportunities in emerging markets right now, this is something that you buy for your grandchildren. I mean, India is growing 6 to 7% GDP for the next 5 years, with EPS at 15 to 20%. And importantly, Indian companies have the opportunity to reinvest this growth and these earnings into compounding opportunities, really profitable return profiles between 16 and 18%. And then kind of bringing it back to that comparison versus China, India now has a larger population than China, a younger population than China. It's benefiting from this, multinationals are looking for global supply chain diversification outside of China. And in addition to that, this is all being run by a democratically elected government, which I think brings a lot of assurance in terms of governance to investors.
To just zero in on China for a moment, does the China risk change under a Trump versus Biden presidency?
I don't think so at this point. I mean, it's really difficult, big picture, to make predictions on China right now. I think it has been for the past 4 years. But in terms of what's happening from a U.S. domestic perspective, it seems like both candidates are kind of competing on who can be more hawkish and who can be tougher on China. So from that perspective, I think a lot of investors are looking for either single country opportunities, just investing in India or just investing in a country like Brazil, or emerging markets ex-China strategies. And then in terms of China, where they're finding opportunity are areas that are less reliant on the rest of the world, less reliant on the West, and where they find an alignment of interest with the Chinese Communist Party. And that's mainly Chinese consumption.
And just, Malcolm, just drilling down on Brazil for a bit there, because I know that's another opportunity you see. How come, Malcolm? And I'm also interested how how has that economy sort of developed and evolved, Malcolm, over, say, the last 5 or 10 years?
Sure. It's a great question. It's been moving with politics, and it's been a political pendulum. We've seen some great things in terms of reforms, tax reform, fiscal reforms, state-owned enterprise reforms to the central bank, and a lot of positive steps and from a big picture perspective. But at the end of the day, Brazil is still a very cyclical story. And at this point, I mean, it's been a roller coaster. Brazil was up over 20% in the fourth quarter. We're down almost 20% in the first half of this year. So it's created another window of opportunity for people to step in. But right now, I think this could be the best trade over the next 6 to 12 months. I mean, this is based off of very discounted valuations, a very advanced monetary policy cycle. The central bank's already cut interest rates 325 basis points, and really significant exposure to a robust commodity base. But let me just take a quick pause there. You guys had Rick on a little earlier before this segment, and he was talking about the risks of ballooning U.S. national debt. And big picture, if you have any concern about national debt in the United States or the direction of the U.S. dollar, which has been amazingly strong the past decade plus, Brazil is a fantastic hedge against that. And historically speaking, for every 1% weaker US dollar move, Brazilian equities have popped 5%. So I think from that perspective, it's really interesting as well.
Well, and I also wanted to ask you about the traditional relationship between emerging markets and U.S. interest rates, right? At a time when it looks like rates are going to go lower, maybe before the end of the year, right? Is that something that tends to be a catalyst as well for emerging markets?
It does. I think it's a really good point because at the beginning of this year, we were all so enthusiastic and excited about interest rate cuts in the United States and the spillover into international and emerging markets. We were thinking first cuts in March, we're going to get 7 cuts this year, fantastic. And since then, all we've heard is kind of more hawkish rhetoric, kicking the can down the road, higher for longer. But despite all of that, I mean, EM should be having a pretty bad year, but it's the third best performing asset class year to date. And gold prices are up, copper prices are up, oil prices are up, EM assets are up across the board. And that tells me that this rally is based off of more structural factors, supply and demand, CapEx cycles, expansionary PMI across the board. And if/when we do get interest rate cuts, that's just going to add fuel to the fire. So I think that we could be at the very beginning of a really interesting cyclical upswing.
Malcolm, super interesting conversation. Thanks so much for joining the show. Really appreciate it.
Thank you, Josh. Thanks, Julie.